And joining us on the phone, billionaire investor Howard Marks. He's the co-founder and co-chairman of Oak Tree Capital Management. So Howard, I want to start big picture here with where you think we are right now, where we find ourselves in America in terms of the economy and the labor market and the stock market. Do you have a sense that there is opportunity right now here?
Well, where we are in terms of the things you mentioned, obviously, first of all, I don't make forecasts. I only regurgitate other people's forecasts. New jobless claims were 211,000 2 weeks ago, 281,000 last week for a major increase. At least one brokerage firm is saying 2.5 million for next week. So obviously, we're heading into an enormous unemployment challenge. The economy, likewise, most forecasters are saying that GDP will decline by 15, 20, 25% in the second quarter, which I imagine would be the worst quarter in history. So these things are not going well at the present time. Obviously, there's a lot of optimism around the Fed's actions, and certainly the Fed and the government are throwing everything at this financially that they can, and I don't believe that anything is off the table. Where will it go? How fast will it trickle down? How fast will it work? These are the questions. Millions of small businesses have had to close now for a couple of weeks. They'll probably be closed for another couple of weeks. That people will lose their jobs in the millions. And how fast will the economy come back? These are all economic questions. On top of that, we have the challenge of the coronavirus disease itself, and we shouldn't lose track of the fact that that's the problem. I don't think you can buy the virus off. So the point is, the economy will stay closed for some period of time. Exactly how long, we don't know. But if we attempt to bring it back too fast, I believe we'll have an echo, a rebound in cases. The U.S. has not taken the draconian actions that Singapore, Korea, China, and maybe Italy have taken. People are still socializing. I still shudder at those pictures of college kids on the beach. What happens when they go home from the beach to their home communities, where until now there haven't been outbreaks. So, I think the outlook for the economy is weak. The outlook for the disease is bad. On the other hand, there's good value in the markets. I liked them before they went up 9% today, more than I do now. But there is good value, and I put out a memo Thursday saying that there's no argument for spending all your money now, but in my opinion, there's also no argument for not spending any.
Howard, you've written a lot about cycles and the shape that they take over time. And, you mentioned that you don't make forecasts, you just regurgitate what others make. But, you rattled off some of those GDP numbers, and those were revised 3, 4, 5 times by some strategists just in the span of a week. And when you see people on the street, people in this business scrambling to throw bigger and broader numbers out there to get a sense of what might happen, does that say anything to you about what part psychologically of this cycle Wall Street might be in?
Well, look, first of all, as you probably know, I put out a memo a couple of weeks ago, and the title was Nobody Knows. So nobody knows what's going to happen with the disease, or I don't think what's going to happen with the economy. And if anybody has a strong position, they should get in touch with me, because I'll bet them they're wrong, whatever it is. There's just no justification for having a confident view at the present time, in my opinion. And Wall Street's takes it as its job to fill the void with forecasts or information. I was talking to one of the major investment houses last week, and at that time they had cut their earnings estimate for the S&P 500 for the year from 173 to 158, which was a decline of about 15%. And when I next caught up with them, their estimate was 115. So the question in my mind is, do these estimates do any good? On the one hand, people like to have information, but what good is it to have information if its probability of being correct is low, as in my opinion it usually is. The point is, nobody knows. You can decide to be optimistic today. You can decide to pessimistic. I don't think you should rely on so-called data, because there is no data with regard to the future. And you know, in the face of uncertainty, my approach is to hedge my bets, not to go all in or stay all out. Even now.
Can we talk about that a little bit more? I guess, I mean, you are known as managing risk, and that's what everyone's trying to figure out right now, is how to manage risk given all the unknowns that are out there that you're talking about right now. Does that mean just keeping your powder dry? Does it mean trying to find some of the values that exist today? How do you manage risk in this environment?
I think that your question is indicative of the challenge. And when most people say manage risk, what they mean is avoid the potential for loss. But there's another risk, which is the risk of missing out on gains. So, you know, let's say that you and I are talking and we say, well, there's a 60% probability that the market will be down 3 weeks from now. Let's say you and I agree. So the question number one is, what do we do in our portfolios about the 60% probability of a decline? But we mustn't lose track of the fact that we also should deal explicitly with the 40% probability that it's up. And what do you do about that? So, you know, if you say to somebody there's a 60% probability of a decline, it's easy to say, well, then you should get out of the market. But what do you do about the 40% probability that it goes up? And if you're out of the market and that's what happens, then you really will have missed out on something and will regret it. So, you know, I prefer to think of risk as the probability of having undesirable outcomes, not just losses, but also gains that you miss out on, and you have to balance the two. And I think that the fundamental outlook, as I said, for the disease and for the economy is poor. But on the other hand, you know, stocks are on sale relative to where they were a month ago, and I think that those sale prices cover a lot of the carnage. So, as I said before, I don't think there's a good case for investing all your cash today, but I also don't think there's a good case for not investing any.
Howard, I want to ask you about what you called some illogicalities in your letter a couple of weeks back. One of them was the not specific. I mean, you made the mention that some people compared this to 9/11, and you mentioned that that's a one-day event.
Oh, can you hold on 1 second, please? Just a whole second.
Hey, Miles, I'm still here.
Hello. Yeah, I mean, I think challenging time and interesting comments so far from Howard. We'll see if we get him back here.
Yeah, I mean, the idea of keeping some powder dry, I think, resonates with a lot of people.
I'm sorry to have jumped away.
Oh, no worries, Howard. I just wanted to ask you about comparisons from this moment to any prior points in your career. I think a lot of people in the investing world right now are really struggling to find any decent analogs to the past. One that you mentioned in your letter that didn't make much sense to you was 9/11. That hasn't really been mentioned quite as often, but it certainly was in the beginning of this phase something people compared it to. Are any pockets of this market that you're looking at reminding you of anything from the past, or are we just across the board in uncharted waters here?
Well, I do think that it has a lot of similarities to the global financial crisis. because that was a sweeping crisis. It began in the financial markets, and the biggest culprit was leverage. There was chaos. There were major markdowns across most asset classes. Of course, it started with subprime mortgages and their defaults, but it spread rapidly. And when assets are marked down rapidly in price, anybody who owns them, either on margin, that is using leverage, or more than they should be holding, let's say, intestinally, more than they have the intestinal fortitude to hold in tough times, anybody who's holding assets in either of those circumstances may be forced to sell. And then, declines produce sales. Sales produce further declines, so you have a downward spiral. And we had a bunch of that in global financial crisis. It turned out to be a crisis of leverage and liquidity. And this one is as well, although not to the same extent. The good news, but there are also differences. That was a financial crisis. This starts off as a health crisis. That time, our lives were not in danger as they are now. That's one. Number two, that time the banks were levered 32 times their equity, and so there were rumors of bank meltdowns, and of course, even some real cases. This time they're levered 1/3 of that, so nobody's talking about problems at the banks themselves. So differences but similarities, and I think it's a relevant comparison. But let's remember what Mark Twain said: history doesn't repeat, although it rhymes.
So we've got a little bit of rhyming going on, and of course there are the liquidity issues that you mentioned. What about the solvency concerns? As somebody who has a lot of experience in distressed assets, what do you think we're going to be seeing here in the next few months?
Well, part of it depends on how fast they bring the economy back, and part of it depends on how broadly they distribute these let's say bailout programs. But if they can't bring the economy back, let's say, I've seen a lot of forecasts that had the economy up in the third quarter. I think that's very optimistic. And if the economy goes 6 months from now in negative territory and starts off down, let's say 15 to 20% in the second quarter, then I think you're going to have a lot of defaults. Now, on the one hand, most debts today don't have covenants, which means you can't be forced into default because you have too little net worth or too little cash or what have you. The only way in this climate, the main way in this climate to have a default on outstanding debt is to not be able to pay interest or principal. So that's good news. That means fewer defaults. On the other hand, in the last 5 years, lending standards have been low, and companies that shouldn't have got loans have gotten loans. And when your business goes to zero, so a bunch of those will default on their interest payments. So I think we'll have substantial defaults, in the next year.
Howard Marks, so great to talk with you. Oaktree Capital. I wish it were under different circumstances, but getting your thoughts on a day like this, we really appreciate it.
I'll come back to discuss the good news in the future.
Fantastic.
Thank you.
I'll hold you to it. Hopefully it'll be sooner rather than later.
Good. Okay. Bye-bye.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.